Welcome back. I'm Majid and this is Financial Crime Awareness Hub. Today the topic that we are going to discuss is drug trafficking, which is as a predicate offense. So drug trafficking is the original predicate offense. It is the typology, and the entire anti-money laundering system was first built to detect it. So every red flag, every reporting threshold, every piece of regulation you have studied so far, somewhere in its history it traces back to the drug money in a way. So this video is not just one more typology, it is in many ways the blueprint for all the others. So let us get into it, and I'm going to give you one scenario, and all the way through this video, before we touch a single label, what it is. So here's the scenario. Just listen, don't try to label anything yet. I'll read it through once completely, then we are going to come back to it. A street-level drug operation in a major port city generates $2 million a month in cash. That cash is broken into smaller amounts and deposited across 40 different bank accounts, each held by a different person. Each deposit just under $9,000. Within 48 hours, those funds are wired to a company that imports electronics, paying for court consulting services that were never provided. The electronics company then pays for a property developer for a stake in 3 luxury apartment buildings. Just hold this story in your head for now. So you see three questions we need to look for before we go further. So which part of the story is placement and which part is structuring? Why does the speed of that second transfer matter? And what does that apartment stake actually represent? We are going to answer all three, but first I want to show you where the story actually begins, because it does not begin with $2 million. So this definition first, as per the study guide. You see, drug trafficking, because it sets up everything else in this video ultimately. So drug trafficking involves illegal production, distribution, and sale of controlled substance such as heroin, cocaine, cannabis, synthetic drugs such as fentanyl. And the study guide makes a comparison which I want you to remember. So drug trafficking operates as a highly structured network, like analogous to a multinational corporation with an extensive global supply. So there are 3 things that we need to focus here. The legal complication, like fentanyl and cannabis both have legitimate medicine usage. Like recreational cannabis is legal in some places around the globe and illegal in others. The exact same substance can be a regulated product in one country and a controlled narcotic in the next. That inconsistency is part of what makes enforcement so difficult. Second thing, the corporate structure. So sourcing, manufacturing, and distribution. The same 3 stages as any global supply chain, like coffee, electronics, anything. Money laundering can occur at any one of these 3 stages. Often it occurs at all the 3 at the same time. So why it matters? You see, drug trafficking is the original predicate offense. Every modern money laundering technique, such as shell companies, trade-based money laundering, structuring, whatever, the works around, trace back to the methods refined in these topologies first. So let's trace it from the very beginning, starting with where the money actually starts moving, which is sourcing. Let's see it in the next slide. So sourcing. So where does the story actually begin? Not with the $2 million in cash. It begins earlier at sourcing. Our scenario does not show us the stage directly, but every operations begins here. So before that $2 million a month even exists, the raw material had to be acquired. At the sourcing stage, when raw material is obtained and refined, criminal organizations launder money through fraudulent trade invoices for chemical precursors and logistics. These payments are routed through offshore shell companies, cryptocurrency mixing services, and Hawala networks. Three things we need to look into, which is fraudulent trade invoices, offshore shell companies, crypto mixers. First, fraudulent trade invoices. So, payments for chemical precursors disguised as legitimate import or export transactions. The false invoice is the cover story from day one. Then, offshore shell companies. So, entities with no real operations receive and forward payments, creating distance between the true buyer and the true purpose of the payment. Then we have crypto mixers and havalas. So cryptocurrency mixing services blend funds to break the on-chain trail. Havala networks move value informally with no banking records at all. So you notice this, there is no clean stage here. Laundering begins before the product even exists. From here, the proceeds don't stay still, they move into manufacturing and then distribution. Let's follow them. So, from sourcing, the proceeds move into manufacturing, and this is where things start to look more like our scenario. Stage 2, which is manufacturing. At the manufacturing stage, proceeds are funneled through agri-businesses, real estate acquisitions, shell logistic firms, and trade-based money laundering. This is where laundering shifts from concealment to integration. The funds start looking like normal business activity. Then we have distribution. Once drugs are sold, traffickers launder the consolidated cash through shell companies to appear legitimate. Integration methods include real estate acquisition in global cities, luxury asset purchases such as art, gold, yachts, rare diamonds, and crypto laundering through exchanges and NFT platforms. Now, here's a real world example I want you to know. The Colombian Black Market Peso Exchange, which is BMPE. So Colombian drug traffickers historically use the BMPE to convert the US dollar into Colombian pesos, settling drug debts or purchasing future shipments while obscuring the origin of the funds. It is one of the oldest and largest informal laundering systems ever documented. So keep that BMPE example in your mind because it shows the same principle our scenario is built on. So move value without leaving the trail that a direct transfer would create. Now we have all three stages on the table. So let's go back to our scenario and put a name on every piece of it. All right. So now let's look back to our scenario, same story, but now every piece has a name. $2 million a month broken into small amounts across 40 accounts, each just under $9,000. That's placement and structuring both at once. The cash physically enters the financial system and splitting the amounts specifically to stay under the reporting thresholds. That's structuring. 40 different people, 40 accounts, each deposit individually, unremarkable, right? Together, they are $2 million. Okay, let's look at the next thing now. Within 48 hours, wired to a company paying for consulting services that were never provided. That's layering and trade-based money laundering. A fake invoice for a service that does not exist. And notice the timing, 48 hours. That's very critical, right? That speed is itself a red flag. Legitimate consulting payments don't follow a flood of random small deposits this fast. The speed tells you the money was waiting to move. The third thing, integrations. The electronics company pay for a property developer for a stake in 3 luxury apartment building. That's integration. The money is now an ownership stake in the real estate. It looks like an investment. The criminal origin has disappeared completely. So one scenario, 3 stages, every concept from this video in one continuous story. Okay, so now let's turn that story into something you can actually use on the exams. We need to see there are 6 red flags pulled straight from the 3 stages we just walked through. We'll see it into the next screen now. 6 red flags across the 3 stages. These are the signals for us as a compliance professionals and those who are gonna be successful CAMS candidates. You need to recognize that. Number one, for fraudulent trade invoices for precursor chemicals, so payments for legitimate sounding goods or services that cannot be evidenced or independently verified, especially in chemicals, logistics, or agricultural sectors. Red flag number two, structuring just below reporting thresholds. Multiple deposits, each individually small, each just under the reporting limits, made across many different accounts by different individuals. So 40 accounts just under 9,000 each, that is the signature. Next, which is number three, rapid movements after deposits. Funds wired out to different countries within hours or days of deposits, especially to an unrelated business sector with no clear commercial relationship to the depositor. Our 48-hour transfer also tied with that. Then number four, shell logistic and agri-business fronts. Companies in shipping, agriculture, or import-export with revenues inconsistent with their declared scale of operations or physical footprint. Number five, real estate and luxury assets purchases, such as property, art, gold, yachts, or rare diamonds purchased through layered corporate structure with unclear beneficial ownership. Our 3 apartments building example tied with here also. Then number 6, use of informal value transfer system, which is Hawala style. So these networks or peso exchange style arrangements. So value moves without a corresponding formal banking transactions. That's the Black Market Peso Exchange example. So before we get to the exam question, which is on the next slide, one real case that shows what happened when these red flags are missed. So in 2012, HSBC was involved in a money laundering scandal, that remains one of the most significant AML compliance failure in banking history. HSBC allowed drug cartels to launder over $888 million through its Mexico operations. The result, a record $1.9 billion fine. And that forced resignation of the global head of compliance. Right? So our role as a compliance is very critical. It's not only, that you say something and you can skip easily. Your decisions has a long-lasting impacts. So before I tell you what went wrong, what do you think the compliance team missed? Take a moment. What actually went wrong is inadequate transaction monitoring and a fragmented approaches here. Ineffective compliance frameworks. Cash deposits inconsistent with declared business activity went unflagged for years. The system saw the transactions. Nobody connected them. That's the difference between having data and having detection. So HSBC had that data. They lacked the connections. Time to test what you have got. Okay, here comes your exam question in the next slide. So here's the question. Which of the following are predicate offenses related to money laundering? Choose 3 out of 5. Option A, armed shoplifting. Option B, tax evasion. Option C, human trafficking. Option D, tax avoidance. Option E, drug dealing. You may pause your video for a couple of seconds and we'll see the answer on the next screen and discuss further what are the right options and why. So the correct answer is option B, C, and E. Let's see why B, C, and E are correct. The correct answers, let's look at it first. Option B, the study guide states that directly. Tax evasion is illegal and is considered a predicate offense for money laundering. That's, item 17 of the FATF list. Okay. So you have total 21 designated predicate offenses. Hopefully I'm not wrong here. The second option, human trafficking. This is also one of the predicate offense on FATF list. Trafficking in human beings and migrant smugglings, generally illicit profits through human exploitations. Option E is also correct. This is also one of the item on FATF list, which is probably number 5. So illicit, trafficking in narcotics, drugs, okay, and any of these substances. The exact typology this entire video actually built on. Okay, so the other two options A and D are wrong. Let's see it why. So robbery and theft is on the FATF list, item number 15, but armed shoplifting specifically is never named in the study guide. This option tests whether you overgeneralize any crime that generate cash into the formal predicate offense list. You need to remember whatever is covered, focus on that. Don't go or you do not increase your scope. So the exam wants the named category, not your own extrapolation, right? So then the next option, which is option D, that I would say it's a trap. Okay, that's why I named it as a trap in the slides even. This is deliberate distinction the study guides draws. Okay, so and it is a whole point of this question. Tax avoidance, even what the study guides calls aggressive tax avoidance, is the legal interpretations of tax law. So only tax evasion, which is illegal, is a predicate offense. One word, I would say, avoidance versus evasion, changes the entire answer here. So before we close, 4 things to take away from this video. First, drug trafficking is structured like a multinational corporation. It has stages like what we discussed: sourcing, manufacturing, and distribution. So money laundering can occur at any stage, often at all 3 simultaneously. This is the original predicate offense. The typology AML was first built to detect. Second, know the 3 laundering stages: sourcing, fraudulent invoices, shell companies, crypto mixers, hawala; manufacturing, agribusinesses, real estate, shell logistics, trade-based money laundering; distribution, shell companies for cash conversions, then real estate and luxury assets for integration. Third, know the red flags such as structuring, many deposits just under the reporting thresholds, many accounts, rapid funds movements to unrelated business sectors, shell logistics, agribusiness fronts, and informal value transfer systems like BMPE or hawala. Fourth, the avoidance versus evasion rule. Avoidance is the legal interpretation of the tax law, not a predicate offense. Evasion is illegal. It is a predicate offense. Item 17 on the FATF list, 21 FATF categories in total. Know which ones are explicitly named and don't extrapolate beyond what's stated. So we are done with the drug trafficking video. I hope this video helped you to clear some of the concepts around this topic. Our next video will be on cybercrime, which is one of the most important topic after this overall AML book has CAMS study guides has revised, and we started talking about generally financial crimes instead of simply AML and CFT. So this will be an excellent a video for all of us. It's a good learning curve because this is one of the new and most important topic, and I would say hot topics nowadays because lots of cyber crimes are happening across the globe. So if this video had helped you to clarify some of the concepts, I would appreciate if you can give the thumbs up, like, or drop your comments. As always, we at Advice Cube, we help many CAMS candidates in preparing for their exams. We have notes prepared for specifically designed for professionals, those who have lack of time. So all the concepts are explained on a high level, yet it conveys a complete concept around all of the things. Then we have roughly around 1700 practice questions, which can ensure that whatever concept you read, you can test yourself and you understand how you will be, behaving, I would say, or you will be preparing yourself for the exam day. So should you need any other guidance, our WhatsApp number is also given on the slide, email address is there. Please feel free to reach out, and I'll see you in the next video. Thank you so much.